Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Last week we saw a sell-off in local equities with the ASX recording one of the worst weeks so far this year. The markets have run very hard in 2024 with plenty of market watchers saying maybe they'd gone too hard. So where should investors be putting their money with that as background? How should they be thinking about asset allocation? Remember, this is general information only and you should always seek professional advice before making investment decisions. Matt Wacher is the Chief Investment Officer, Asia Pacific at Morningstar. Matt, welcome to Fear and Greed.
Thanks a lot for having me, Sean.
I want to get to asset allocation, but let's just talk equities first. The market, notwithstanding last week's pullback somewhat, it's run pretty hard this year. Is it a surprise? Has it run too hard? What's your take on that? I'm talking the local market here.
Yeah. I mean, I think that even with the last quarter last year and what it's done this year, I think it's been a pretty heroic kind of effort for the market to get up to where it's at. I think, probably a little bit ahead of itself in certain pockets. I think that it's probably due a pullback. Whether this is something more substantial or not is yet to be seen. But I think the market's not overly valued. It's not cheap, but it's reasonably valued at the moment. But you want to be searching for those pockets where where you've got a bit of a margin of safety, is how we would play it. But certainly due for a bit of a pullback. It's not unsurprising.
So I'm just going to keep this line of questioning. If you're searching for pockets, we know in the US, for example, the Magnificent Seven, well, probably the Magnificent Five, have actually really led that market for a long time. And this year, a couple of those stocks have dropped out a bit. But is it the same in Australia? Has there just been some stocks that have really pulled the rest of the market along, or some sectors?
Well, I mean, maybe we'll just focus on the way we think about it. Like if you look at the banking sector, for example, CBA has been the standout, really. I mean, the other banks haven't done badly, but CBA has got to a point where its value, we think its valuation is a pretty high at this point in time. And so we would steer away from CBA and look at other banks like Westpac, NAB, ANZ. And I guess that's kind of what I'm talking about in terms of pockets, looking away from the largest of the large caps, similar to the Magnificent Seven, and looking for where you can get slightly better value but still being exposed to the market. We don't think it's a time to a real huge risk off time at the moment.
I love the term risk off because it seems to be, the phrase du jour at the moment. Let's talk about asset allocation then more broadly. When we talk about asset allocation, we talk about equities, we talk about bonds, we talk about alternates. Now, alternates might be, and this is for sort of infrastructure, it might be real estate, it might be private equity, all sorts of things in that very generic term. How should investors be thinking about asset allocation at the moment, given where bond yields are, equity markets are, etc.?
Yeah, I mean, we're in an environment now that is much more conducive to having a diversified portfolio. I think, obviously 2 years ago, end of 2021, bond yields very low still, equity markets at extremes in terms of valuation, and there was really no place to hide. We think you can build a much more diversified portfolio at this point in time, and that's really on the back of bond yields. We think that, yields, government bond yields in the US, in Australia, pretty much globally are pretty attractive at this point in time, and they're going to give you that real diversification benefit if something does go wrong, if we do get a recession. And I think, for those that are scarred from kind of 2022 when bond yields rose significantly and, the poor old conservative investor might have probably had a capital loss. I think we're at a point now, if you just do the basic, well, it's not that basic, but the maths, you're not going to be hurt as much if there is another rise in yields. You're going to be protected by the current yield of around, maybe it's 4.3, 4.5% from a 10-year bond. You're going to get some protection there from any continued rise in bond yields because you get that as the coupon. You get paid that. So it's reasonable to hold a much larger, a much more significant perhaps rather than larger allocation to bonds in portfolios. We've certainly done that. And interestingly, for a growthy type investor, you can probably hold more growth assets because you've got that diversification benefit coming from bonds. And conservative investor on the other side of the fence, no need to take as much risk because you're getting, yield from your bond markets at this point in time. So, bonds are really able to be the cornerstone of a portfolio again at this point in time. And it allows you to do things in the equity market, potentially if we think that, we're going to get another leg up in growth, like GDP growth I'm talking about, or, where we're not going to get, that recessionary scenario seems to be fading, then you can actually, with bonds where they are, you can actually take on more growth assets at this point in time than what you could say 2 years ago.
Okay, so let's stay with fixed income. What about investment grade credit? So it might be bonds from banks, things like that, right out to high yielding credit. Where do you sit with that?
I mean, investment grade credit spreads, all credit spreads are pretty tight at this point in time. You're getting the all-in yields are very attractive, don't get me wrong. But we think, you want to have slightly diversified portfolio of bonds. You don't want to have all your eggs in one basket. You probably want to look across the credit spectrum. But for example, with high yield, if we're looking at high yield bonds, the spread that you have to take on now, very, very tight relative to history. And even though you're getting a big yield, if high yield bonds are going to do well, equities are probably going to do well. And so we'd rather take the risk through the equity market at this point in time and some of those pockets that I was talking about before, where you can get better valuations and better exposures rather than high yield. In terms of investment grade credit, again, there's some value there, but we'd rather actually just own duration government bonds, to be honest, and take risks through the equity markets where we think it's warranted.
Stay with me, Matt. We'll be back in a minute. I'm speaking to Matt Wacher, Chief Investment Officer, Asia Pacific at Morningstar. What about alternatives? And as I said, it's a broad name, that many sinners in amongst alternatives. But what property, infrastructure, PE, those sorts of things. How should we think about those products, particularly given what you're getting on a 10-year bond today?
Yeah. Look, I think that I'll start with property. I think, property, there's probably some stories out there and to come in terms of commercial property. But, I think that that's starting to look reasonably attractive. And, it hasn't been like that for quite some time. We're starting to see a bit of a bottom in terms of listed property at this point in time. And so, we're starting to take a nibble there. We think that in terms of where interest rates are, obviously with interest rates rising, you had the double whammy of a bit of oversupply in lots of areas in terms of commercial property and, interest rates starting to bite. But we think that we're in a situation now where things start to stabilise. We've started to look at a few REITs around the place as well to put in our portfolios, not just here in Australia, but globally as well.
Okay. Infrastructure?
Infrastructure, yeah. I mean, infrastructure, good long-term asset. I think that we try and stay away from, communications infrastructure or anything tied to development. And I'd say the same for property at this point in time. Development we'd steer clear of. But you're starting to also get pretty, reasonable returns, expected returns from infrastructure as well. But we think property out of those two is probably more attractive at this point in time. And so, leaning in terms of alternatives or unlisted asset classes, leaning more towards property rather than infrastructure at this point in time, in terms of adding to the portfolios. And then if summing up in terms of private equity, we're still fairly cautious on private equity. I think that, again, there's going to be opportunities out there. You want to be picking the right investment managers to partner with there and make sure that they have the skills and that they've been through these kind of environments before where it's been hard to get, realizations on the assets that you have. You've been a falling market for private equity the last probably year, 18 months. But again, probably starting to see a bottom in that market. And there's certainly IPOs coming back on board globally. So that's a good sign that there's a bit more confidence out there.
Matt, it almost sounds old-fashioned what you're talking about. It's like an old-fashioned asset allocation suddenly.
Yeah. I mean, we were saying, we were in the camp a couple of years ago saying the old 60-40, 70-30 portfolio's dead. We think it's been resurrected. It took a bit of a hit in the markets, but yeah, you're able to build a pretty reasonably diversified portfolio at this point in time. It's going back to the future. But I guess the key thing is that what's going to actually happen in the markets. And while we don't forecast things along those sorts of lines, we really think that focusing on valuation at this point in time and having that margin of safety in any of the assets that you're looking at is important, because things can turn very quickly, especially with some parts of the market. You mentioned the Magnificent Seven and the Magnificent Five. It may be now. The risk reward there is certainly in favour. The risk is certainly higher than the reward. Looking at this point in time, they need to generate, particularly those the Nvidias, etc. They need to generate some pretty hefty free cash flow over the next little while to give investors what they want in terms of the returns that they've already kind of brought forward. And that can happen. These are great companies, but again, you might be wanting to look somewhere else to get a better risk reward at this point in time.
Matt, thank you for talking to Fear and Greed.
No problem. Thanks a lot, Sean.
That was Matt Wacher, Chief Investment Officer, Asia Pacific at Morningstar. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.